Welcome, guys. Today we'll be running through preparing your end of financial year tax considerations. You're joined by myself. My name's Connor Spencer. I'm the team lead of our online company registrations team and our legal and accounting subscriptions. I'll introduce him pretty early on, joined by Tim. Tim is our head of tax and accounting at our Lawpath Tax and Advisory. He's a highly senior chartered accountant with over, I believe, 17 years experience, Tim, and has represented people at a director's, resident director's level. And I believe you've got some international experience, haven't you, Tim? I was checking out your LinkedIn.
Yeah,
Um,
a bit of that, bit of everything.
yeah, you're across it all. So needless to say, he's an absolute expert. If anything, overqualified for us, I feel at times. And you're all in good hands. We'll be taking you through today's content. We'll be going through those important tax deadlines and some compliance tips, maximizing deductions and offsets, and going through some common end of financial year mistakes to avoid, preparing your financial reports and documents, and finally, the tax planning strategies for the next financial year. But really what we want to stress is to basically get all your ducks in a row, have your house in order before we break up this calendar year for Christmas and New Year's, and people taking a lot of time off. We want to make sure you're in as good a position as possible this side of the calendar year. So, you're on for a winner come 2025. And as Tim mentioned, we do have a Q&A at the end. However, feel free to pop in your questions in the Q&A chat. And I think Tim might stop if he sees a few and answer a number as he goes. So a bit about Lawpath, if you are finding us for the first time. We've had skin in the game for 10 years now. Now, a lot of you will be already subscribed to the platform, or you would have done company registrations through the platform, so you're pretty familiar with us. Some of you even may have actually been to our client event last week, where we got to really sort of have a bit of bragging rights and show off that we are now one of the milestones we've hit is we're now the largest incorporator of new business in Australia, and we've assisted over 500,000 businesses within that 10-year time frame. We've also hit 500 million legal fees saved for small businesses just like yours, and we're aiming, by 2030 to have assisted over 1 million businesses. And we'd love to do the same for you. Our mission, as I said, we're the largest incorporator, but we're all very much a one-stop shop. We've got a legal, accounting, you've got your asset compliance, business support, trademarking. We have it all on the platform to assist you and make your time with your business as seamless as possible. I imagine no one started their business to think about crunching the numbers or doing their lodgements and financial statements or getting contracts in place. All we want to do is basically take as much of this off your hands as possible, but also provide you with a platform where you can seamlessly get it all sorted, within the day, if not within 20 minutes with some of the contracts you can self-build. Oh, another stat we're very, very proud of. So on the left there, you've got the survival rate of businesses within the first 3 years. We've taken this statistic from the Australian Bureau of Statistics. Businesses that are registered with Lawpath and are using our services actually have a 64% survival rate. And hopefully, as we continue to work with people and expand our services, we'll be getting that number even higher. So I just wanted to showcase quickly what it actually looks like in the platform. I'll touch base on this towards the end of the webinar when we discuss how Lawpath can help. But we have this legal contract management system. Those of you who are using us may have noticed these recent changes to us. And what we provide is over 500 legal documents on the platform. These have all been drafted by our team of commercial lawyers. They're up to date with Australian legislation. And if changes are going to be made in rules and regulations, we have those ready to go for those launch dates, for lack of a better word. We're also supported by the Lawpath AI. You'll see there, you've got suggestions, draft, and insight, which was a great tool to assist you with creating the documents. But we also have the Lawpath AI for asking it some good legal questions. There's a draft feature where we can draft additional clauses and provisions. A review feature, so review documents you're using on the platform. But if you have something external, you can actually also upload it to your account and have the AI and raise the hand. Just pop a question in if you have a question there and into the Q&A. I can't see it at the moment. But yeah, it will also review your external documents as well if you do pop them in there. And finally, there's a simplify and translate feature. Simplify is a great tool. It's one I use particularly myself, as I don't have a formal legal background. You highlight a bit of text and it will explain it back to you in layman's terms. As touched on, like we are a one-stop shop, so we have the ability for you to make changes to your business, whether that's through shareholders and office holders, changing of address, changing of date of birth, so all of it on the platform there. If you are on our asset compliance plan, you'll be able to make unlimited changes throughout the year, with the exception of a change of company name. But if any of you do have a list of company changes you need to make, you are legally required to make them. I'd recommend checking out our compliance tab on our platform. And finally, many of you will be familiar, this is all our bread and butter. It's the legal and accounting advice and subscriptions that we have for our clients. These are some of the most popular and best value plans we offer. We cover a litany of topics. There's a few examples there. If anyone would like more information of how we could specifically help your business, whether it's through documents or specific legal topics you should be discussing with a lawyer, just comment yes in the chat or shoot me an email, whichever's easier. And I can run you through some things you should be aware of, and even give you a more detailed platform demo as well. And in line with today's topic on taxes, we're just making everyone's tax time as easy as possible, whether that's through managing your BAS lodgements. I've already spoken to a few people, as you know, Tim, who are behind on the last BAS, if not the last tax return, if not several years of lodgements they need to get done. We want to help you have as a proactive response, proactive approach as possible. So you are on top of this. You're not going to get called out with any late fees by the ATO, and it's always done by highly senior chartered accountants like Tim. And that's me. I'll hand things over to you, Tim.
Thanks very much, Connor. And Amir, and I think it was Kevin, I see your questions and I'll come to you shortly. You won't have to wait too long. Okay, what are we here talking about? Connor dropped a clanger. He said end of financial year. We're done and done and dusted with the end of the financial year. That was months back. We're talking about the end of the calendar year. And for those of you that think I've made a trap for myself, why are we talking about deductions at the end of calendar year? I do remember, of course, that the financial year finishes in June. So why now? Let me answer that rhetorical question with a question back. Why not now? The best time to look at reducing your taxes is now. It's yesterday. It's always. As small businesses, you will feel the weight of regulation and of taxes coming at you thick and thin. We always want to look out for what we can do best. I'm going to give you a little bit of insider industry information that will not shock those of you that run a small business, which is that in the run up to the end of Christmas, so between this silly season of Melbourne Cup all the way through to Australia Day, business is pretty slow for accountants. Now, take advantage of that. Some of these changes to really boost up your tax effectiveness of your business require a bit of work. Restructuring requires a bit of work, a bit of advice. Now's the time to pounce on your accountant's feeling of stress, thinking, how am I going to book any revenue between now and December? What am I going to do? I'm going to be sitting on my hands while everyone else is at the beach. Keep your accountant busy. You might just find that the prices you're offered are better now than in the new year and in the run up to 30 June. So that's really why the end of calendar year is a great time to get thinking about your taxes. For those of you that like a New Year's resolution, and you might feel like you've been ostriching, burying your head in the sand over your tax affairs this year, let's get you a clean slate. Let's get you started 2025, all nice and clean. What are we talking about when we're talking about tax effectiveness? It often starts from day one with your business structure. Perhaps you've got a simple structure. I love a simple structure. If it's working for you, if you've got a company, if you've got a little bit of income, a little bit of expenses, and you're running a pretty simple, straightforward business, a really simple incorporation will do you just fine. there might be times where that starts to get stretched at the seams. If you're making a lot of profit, potentially that's not the best structure for you. If you're looking to expand and grow, to spin out new businesses, to attract investment, it is often not going to be the best structure for you. It might be time to add a holding company. It might be time to change the ownership from mum and dad to the family trust of mum and dad. And we can go into why that is so beneficial a little bit later. Those of you who have seen some of my previous webinars know how much I love talking about trusts. What are some other tax issues when you're doing restructuring, when you're looking at your structure a bit later? Capital gains tax starts to rear its ugly head. And that's when we start to look at small business concessions for capital gains tax. There are many of them. Let me pause and answer a few questions. And you've been very diligent in waiting. Lawpath is not a substitute for Leap. Leap, as I understand it, is a legal practice management for legal practices. Lawpath is not. It certainly has precedent documents, that document library that Connor was talking about, but it does not help you. It will not let you run your legal practice through this software. So I hope that helps. Amir, acceptable company tax deductions. I promise we'll get to it. So hold your fire on that one. We've got lots to talk about that. And Kevin, nice, easy one. How can you use trust carried forward losses? Make some trust profits. It's easier said than done, right? The benefit of having those losses is that in the future, when you make profits, you'll be able to reduce your tax payable. Thank you very much. Connor, can we move forward? So what we talked about here is my pet favorite topic, this golden standard of tax effective and legally legal risk minimization structures, this dual company structure of having a holding company at the top and then a different operating company for every line of business that you're in underneath. Why do we do this? It's not just to create more work for us. No one likes doing more work than they have to. But the reason is, if you are looking out to get investment, trust me, if you have 5 different operating companies and you're looking to get investment in all of them, updating your ASIC records and giving 5 different shareholders agreements and all of the documentation behind that is almost impossible to register. Having a holding company above that owns all of the interests in that operating company will allow you to attract investment into one vehicle. It's very, very straightforward. Doesn't have to add a lot of tax complication. You can do what's called tax consolidation and still just lodge one tax return. The legal benefits of this structure is that you separate your risks, your liabilities. If you're running a business, odds are you're exposing yourself to the risk of litigation. You're separating that from the ownership of your assets, your valuable intellectual property. That's what we like to do, so that any sort of risk is ring-fenced or contained to a particular operating entity. Now, I'm no lawyer. Certainly work with a lot of them, and I've seen how well this structure works before in terms of de-risking. Thank you, Connor. Let's move on. Family trust, even better. If we've got this beautiful structure that I've already gesticulated at the screen at, we've got our holding company, we've got our operating companies as we go. Think about adding one extra layer at the top, a family trust. Now, rather than owning the shares in this holding company yourself or with your partner or with a business partner even, if you own this interest through a family trust, you gain an incredible amount of flexibility. Family trust is basically the way that you separate the legal ownership from the beneficial ownership of your business. What does this mean? It means you wear a couple of hats. It means you wear a hat as a trustee that says, I have an obligation to hold these assets, to own my business, but I do so with the discretion that I give the benefit to certain people, typically your actual working directors in the business, potentially other family members. Particularly, we love adult children. Very, very nice tax benefits from that. Why does this work so well for us? Again, it's another layer of legal protection of your assets, from your risks. I wouldn't say unwanted, the perhaps unintended benefit of this, but it's very much accepted, is that this alienation, this separation of legal from beneficial ownership and this discretion allows you to decide who gets the income from your business ultimately? Who ultimately gets the benefit of your profits? If you own the shares in the business, the profits go to you. Fantastic. Unless you're earning more than $200,000 already, in which case those profits that you make from your business will be taxed at 47%. If you have this benefit of the family trust up the top, you get to search around come 30 June and look at the potential beneficiaries and look at people who potentially have a much lower income, perhaps a non-working spouse or a less working spouse, perhaps some adult children who you've been funding their university fees, things like that. There's always flexibility to say, well, actually, rather than taking this money for myself, and I'm already on $200,000, I can actually decide to spread the profits amongst my family members in a really tax effective way. You'll very quickly see in this structure, yes, it takes a little bit of doing, takes a little bit of setting up. It's a minor increase in your compliance costs a year. It will pay for itself 3, 4, 5 times over in year one. And from going forward, it's pure profit. So it is a very good structure. It's not for everyone. It's a little bit of extra complication, but if you're making a lot of money, it makes a lot of sense. Once you've got that structure in place to own your business, of course, use it to build your family wealth as well. Use it to buy shares if you're interested in that sort of thing. Crypto, go for it. Anything that you want to own it through your family trust. You get the benefit again of those of that flexibility. And just kind of while you move on, we'll just have another quick look. Down the bottom, can we run a business with a student visa? Can we keep an Australian business? If you start a company in Australia, you're required to have an Australian tax resident director at all times. Now, you could create that business and appoint someone else to be a director when you leave, but there must at all times be a resident director. Good question. Donna says, is this structure preferred if we're looking at creating a franchise? Well, I'm going to assume franchisee or franchisor. Actually doesn't matter. It's a fantastic structure, whatever business. So very good. The benefit of an IP holding company, again, just another layer of abstraction, another layer of separation between intellectual property, which is fantastic. It's very valuable. It's very important to protect. You're ring fencing it. You're saying, well, if something goes wrong in the operations, if you're sued by an employee, if you're sued by a disgruntled customer, it doesn't have to be legitimate. They come after you, they try and attack your assets. Well, too bad. This company that they've got an issue with doesn't own this. It might have a right to use the intellectual property, but it doesn't have any right to own it. It can't come after the intellectual property. So thank you for that question. Michelle, good question. I might leave that one to Connor to maybe he can reach out and show you a bit more videos around the platform and how it operates. Sarita, yes, the building the documents is fantastically easy. Even a Luddite like myself, I've drafted agreements in it, and it's fantastic. The upgrade of the AI system is brilliant. It will hold your hand through it. Fantastic. I think we're up to share capital. Share capital is one of those things that it's not the end of the world if you've done it wrong day one. Please don't be offended if we're saying create at least 100,000 shares and you've only created one. It really doesn't matter. It's best practice, particularly if you're looking to attract investment to create a large number of shares with a low value. The reason being is that it's then much simpler to add or issue some shares to new investors coming in without having to give away the entire farm. If you imagine a scenario where you've only created 1 or 2 shares in your company, you then look to attract investment, you issue one more share, they've instantly got 50% of your business or 33% of your business, depending on where you started. If you've started with 100,000, you can easily issue 1,000 new shares and give them a much smaller ownership structure. If you have set up with one, I beg your pardon, if you have only set up with 1 share, you can do what's called a share split. We can get you there. Don't worry too much about it. You might be thinking about founder shares. It's one of those quirks of the American system that seems to be infecting Australian startups, in that people get very concerned about how you describe whether your shares are ordinary shares or founders shares. From a tax perspective, we couldn't care less. It's very much about just describing something that you'll put in your shareholders agreement that will give you as a founder enhanced control beyond that of an ordinary shareholder. So you might be in a position If you have founders shares and if you describe this in your shareholders agreement and properly lay this out, you might be in a position where you only have 10% ownership down the line, but that you still have board representation or certain control in shareholders meetings beyond that you would ordinarily be entitled to. We've got a couple of questions. Distribution to non-residents, no, wouldn't do it. It's taxed very, very highly. So we always recommend distributing to local residents only. Hendrik, we said, are there any tax benefits for claiming businesses as a sole trader while running at a loss? You get to keep those losses carrying forward. So I guess that's a benefit. Much like any other business, you can carry forward business losses subject to a few rules, even as a sole trader. Thank you very much. Capital raising. So cap table, some of you have heard of it, some of you haven't. It's not the world's most complicated thing. It doesn't need to be. It can be a pretty straightforward Excel file, something similar like that. It just outlines in one easy to read page, what does your current ownership look like? And more importantly, what does your ownership look like into the future? Potentially, you've outlined some capital raises, some Series A through C, perhaps even more, perhaps some pre-seed, whatever description you give it. It's the idea that as you raise more money, your own interest will diminish. And it's just a way of tracking that and of understanding that at each capital raise, depending on how it's set up, your ownership will diminish. So it's good to have, it's always good to have an accountant look at it as well. It can get a bit fiddly. There are plenty of fantastic models and templates out there. I encourage you to have a look, and I encourage you to talk to your accountant about how it works in the future. Now, it's also important to note that there'll be some things out there without complicating things too much. There might be options on the table. There might be convertible notes or agreements for future equity that don't represent share capital now, but might in the future, depending on certain conditions. You'd also capture that in your cap table. Thanks, Connor. Very important. Shout out to the lawyers at Lawpath. This is something that I've seen done incorrectly by, it's got to be 50% of small businesses that I've seen that have gone the startup route and have sort of raised capital. It is very, very difficult to keep records, the sort of records that we'll need, and maintain records with ASIC that reflect what's actually gone on. Trust me when I say you do not want to be sorting out your capital raising records 3 years down the track, because no one can agree on what was agreed upon. ASIC will tell you one thing, the founders will tell you another, and the incoming investors will have often an entirely different perspective. Make sure that you please do, if you only use one bit of professional advice in your business, please, when you're raising capital, make sure you engage lawyers to manage this process. They will make sure that you get your correct documents signed, maintained, all of the different assorted parts, the shareholders' resolutions signed to make sure that everything is in effect. There is just so much to do there that I thoroughly recommend not doing it yourself. You will need to be focusing on the deal, and your lawyers can take care of the boring bits, the boring but important bits. These shareholders' resolutions, when they get missed out, are very hard to unwind. Thanks, Connor. We've skipped right ahead now. So this isn't strictly a deduction at all. The R&D incentive is a deduction on steroids. It's actually a tax offset, and it's for most businesses, certainly the sort of businesses that we often see at Lawpath, it is a refundable tax offset. That means money in your pocket for doing something that you might otherwise be doing. Why does the government want to give you this tax offset? First of all, how much is it? It can be up to 43.5% of your eligible expenditure. If you are undertaking these research and development activities, and it can be a difficult eligibility process, but if you are found to be eligible, you say you spend $100,000 on these R&D activities in a year. If you're in a loss position, which often you will be starting up a business, a loss sufficient to cover that, you will likely be receiving a very nice refund into your bank account of $43,500. So it's a very, very valuable scheme. If you imagine the way that these things can snowball, you'll usually spend that $43,500 on next year's R&D, which again will generate a 43.5% refund. So it can be incredibly, incredibly beneficial. Now is the time to be talking R&D because the contemporaneous record keeping requirements are pretty strict. I've seen a number of R&D reviews in my time and audits by the ATO and by Oz Industry. If you can show them that you're keeping documentation from day one, rather than scribbling it all down when you speak to your R&D advisor at the end of the financial year, you'll be in a much, much, much better position. So start talking to your advisors now. I do again recommend you probably don't go it alone. R&D is complex. There are reasonably low priced, very competent people that can do it for you, and talk to them now and they'll help you get your records sorted now. Thanks, Connor. ESOPs or ESS, as the Australian law calls them. Everyone else in the entire universe calls them ESOPs. I don't mind. They mean the same thing. We're talking about employee share option plans or employee share schemes. It's at its core a way of giving your key people in your business access to shares in your company. Now, why on earth would you want to do that? It's your business. You've paid for it. You've taken all the risks. Well, put it very simply, for the same reason that you pay your employees, in that you want to encourage them to do good work and to build your company. And what better way to build value for your business than exposing them to the risks and rewards of running that business? Well, typically just the rewards. If you imagine a scenario, if you compare the two senior employees, one of whom has 2% ownership in your company and one of whom doesn't, they will be differently incentivized to make certain decisions. They might work a little bit harder. They might be less willing to take a little cheeky sickie from here and there. It's a fantastic way both to attract key staff and to retain them. Why it's so good to retain them is typically on these schemes, you'll have a vesting period. You'll eke them out little bits of shares every year for 4 years typically. It's a great way of keeping them there for the 4 years because there's a chance, obviously, that they won't get their full entitlement if they leave early. A lot of businesses will set aside, about 10% of the entirety of the shares in their business for this purpose. That doesn't mean they give it away day one. It means that they might give a little bit away now and they might keep some for the future. If you're worried about how this looks to VCs or other funds looking to buy into businesses in the future, don't be. They will often insist that your company have an ESOP pool. They want to see key staff incentivized. So this is very, very common. The ESS, there's a startup concession for businesses under 10 years and meeting a few other thresholds. You can defer tax. So you won't be taxed up front on receiving these interests. And you can basically have it taxed as a capital gain when you eventually make some money selling the shares down the line, which, as we know, is much more beneficial than income. So it's a great scheme. We might move on, and while we do so, I'll answer another couple of questions. Mason said, can you get the R&D incentive if you're part of a corporate group where a different subsidiary has more than $20 million turnover? There are complex aggregation rules, Mason. If I had to give you an answer now off the top of my head, I think you will probably be aggregated and say that you will not get a refundable offset. You'll probably be under the less beneficial scheme where the offset can only reduce your tax to nil and won't be refunded. But you should certainly check with your advisor, Mason. It's a very, very good question. Sarita has said, would R&D include community surveys and other research? There are exploratory parts to R&D where seeking market fit can be eligible. It's at the lower end of eligibility, and you should be careful there, Sarita. It's certainly starting to smell like it's not going to be eligible, and I thoroughly recommend you consult with an expert on that. Christelle or Crystal, pardon me, has said, can we get access? Certainly you will receive a recording of these slides later. And Rod has said, are you limited to a type of entity for an R&D claim? Look, you typically see companies. That's a very good question. I've only ever done company R&D, but off the top of my head, I don't know if other entities are eligible. That's a very good question. I'll have to get back to you on that one, Rod. Small business tax concessions. Back to the slides, back to the fun stuff. Small businesses in Australia are taxed at a lower rate than big businesses. We get 25% and the big dogs get 30%. So fantastic, slightly lower tax rate. Reasonably competitive in the world. A lot of people complain that it's too high. I think it's probably there or thereabouts. It's probably not going to move anytime in the future if you're banking on that. I think it's probably settled at a rate that everyone's pretty happy with on both sides of the political aisle at the moment. The great news is, as a small business, the initial cost to you setting up the business, you used to have to do this ridiculous system where you can only get a tax deduction over 5 years. No, they're now immediately deductible. So any costs, you pay Lawpath to set up your business, you hire some lawyers and some accountants, they will be immediately deductible, even if your business isn't quite up and running yet. There are simplified depreciation rules. And more importantly, there are these immediate write-offs for business assets, which for some reason we cannot settle on a number. Every year, we have to go through the rigmarole of waiting for Parliament to pass these rules. You can go with a reasonable degree of confidence that it's going to be $20,000. During COVID, it was practically unlimited for a while. It's created a lot of headaches and working out when an asset was in use, and a lot of dates to keep in your mind. Do just talk to your accountant, but there are certainly rules if you're going to buy some capital expenditure that normally you would depreciate. Small businesses have the option to immediately fully write off, which is very, very beneficial. Thank you, Connor. What are these immediately deductible expenses? It's what you'd imagine. It's when you're speaking to lawyers and accountants to seek advice, how best to set up. All of that's going to be covered. All of your government fees in relation to that advice, getting the ASIC fee that you pay to register a company, any stamp duty that's going on in relation to transfer of assets or business, that's also included. We'll jump ahead, Connor. Budgeting. Why are we talking about budgets when it's already November? Because you might not have done one. It's something that's pretty common, particularly if you've been running your business for a little while. You might feel like you know it like the back of your hand. I always recommend, certainly for new businesses, but also for ongoing businesses, take a step back. Look at how you went last year. Look at how you're going this year. Have a budget in place that maybe it's not 100% accurate. Maybe you don't have to spend 10 hours on it, but have a look at it. It will help you understand the unexplainable bits of your business. When you sit back and you think, I know exactly where this business is going to end up, and then 9 months down the track, you were totally wrong. It gives you pause. Document your reason for why you think your business will hit certain targets. Reassess that budget when it comes to year end. In 6-7 months' time, when we're hitting 30 June, why did things differ? It will impact the way that you set your prices. It'll impact the way you pay your staff. It will impact everything, and it will help you start your budget for next year. So even if you don't have a budget in place now, I recommend doing a 6-month budget for January to June. Now's the time. You're a quarter and a bit of the way through FY25. You've got a pretty good sense probably by now of how your business is going. Put your skills to the test. See how you think you're going to go in 2025. Let's circle back in June and July and see how you really went. So with this budget, understand your objective. It sounds silly. Often your objective is to sell a widget for enough money to pay for you to fund your living expenses, but often it's not. Do put your objective in place. Are you keen on growth? You don't have to be. Some companies are pretty happy doing what they're doing. If you have a growth strategy in place, how are you going to fund that growth? Are you going to fund it out of prior profits? Are you going to tip some money in? Are you going to start to do things differently? Are you going to cut costs? You have to understand how the market's looking as well. Of course, these plans don't exist in isolation. Talk to your friends that you know, talk to your industry connections. People are pretty open in Australia. I think certainly we talk to a number of different accounting firms, and we share notes. We see how people's businesses are going. I think everyone's pretty happy to help each other. Go out there and talk to people, see what they're doing. Do your research. Thanks, Connor. We got an interesting question there. Can those deductions be backdated to a previous financial year? And who at Lawpath would be best to provide the recommendation, lawyers or accountants? I'd go with the accountants on this one. Anything to do with tax is really my preserve. I'm the head of tax here. We'll reach out to you, Renan, and see if we can have a chat. Yeah, that you can sometimes go back into previous financial years. You can actually open up a prior tax return that you've lodged, and you can make amendments. So we can certainly have a chat with you on that one. Thank you for the good question. Expansion considerations, I think we'll skip that one, Connor. I think we already talked about the whole idea of expanding before, but in terms of, look, from an accounting and a tax perspective, expansion brings new challenges. Your finance function, which is a nicer way of saying your accounting team. Finance function sounds like we're all a bit more impressive. Often, if you're a small business, your finance function is you. It's you and your Xero file or your MYOB file, reconciling transactions, not always knowing exactly what you're doing, but enough to get by. As you grow, you'll have to start thinking about, look, am I big enough to require a bookkeeper, either a virtual one or an on-site one as part of my team? Is the level of advice that I'm getting from that bookkeeper enough? Do I need a CFO or a financial controller or something like that? Do I want to be doing payroll? Do I want to be doing reimbursement claims as the director of a small business? Not really. I'd rather focus on building value. Looking at your finance function as you're growing and expanding is really, really important, because if you let it get out of hand, it's very hard to get back on track. Excruciatingly difficult. I've seen some really, really difficult scenarios where things have been let slide for a couple of years, and it's really complicated to get back on track. And it often comes with some very rude tax shocks once you are back on track. So do just keep an eye on it. Don't think that you have to go it alone. There are lots of options out there to suit your budget level. There are finance functions. There are firms that are coming out the wazoo that will help you out with this. We will certainly be happy to take a look for you as well at Lawpath. It's just important to talk to someone. You know, don't bury your head in the sand as many people do. Thank you, Connor. I've already talked to you about the idea that you feel under threat, under the surge of taxes coming out of nowhere. Guess what? When you expand, they only get more complicated. Fringe benefits tax is a particularly rude one that gives people nightmares. You might think you're doing the right thing. Once you're a small company, you've brought on your new hires, you've got these staff, you take them out to make them happy. You take them to the football, you take them out to the pub every Thursday and do a slap up meal and get on the beers or something like that. Fringe benefits tax will come in, rear its ugly head and say, you are providing a benefit to your employees in return for the work they're doing. We would very much like to tax you for doing that. What's the rationale there? Well, if you give your employee cash, that's certainly taxed as salary. The ATO would very much prefer you to give them cash, because they can track that. They've got access to everyone's banking records pretty much. They've got very, very high visibility through payroll systems and through single touch payroll. They know who's getting what and they can tax you. If you're getting tickets to the footy, that's very difficult for them to track. So they prefer that you didn't give fringe benefits, and to reward you when you do, they will give you a very difficult tax problem to have, which is that even if your employee is on $40,000, $50,000 and therefore has a pretty low tax rate, they will tax those at effectively 47%. So fringe benefits or non-cash benefits are taxed highly. Compliance for FBT is a pain in the butt. I say that with all due respect to people that like doing fringe benefits tax. It's not terribly enjoyable. There are exemptions and concessions out there, but it's going to cost you accounting fees to do it. So I would recommend trying to skirt around it if you can, but just bear it in mind. Payroll tax. Are you not already paying payroll tax? No, you're not. You're paying pay-as-you-go withholding tax to the Commonwealth government. Payroll tax is when the states will step in and say, okay, you've got a bit of seriousness about your business now. We would like a bit of that as well. And often it's around the 5% above a certain threshold mark. But of course, all of the states are different. So if you employ people in multiple states, good luck to you. It's very irritating to file your different payroll tax requirements. Your reporting frequencies might go up. If you're a small business, you might only have to lodge things annually or perhaps quarterly. That as you grow, you will be expected to file monthly, or in the end, I think you get big enough that you're filing stuff weekly when it comes to payroll. So there's be prepared for that to go up. As you're expanding, particularly if you're restructuring, we mentioned quickly capital gains tax is something to certainly consider, something to look at. Again, there are fantastic concessions in place for small businesses, but it is going to take your accountant a little bit of work to talk you through them. Director loans is another thing that people often don't consider. If you as a director are borrowing money from your company, the ATO is not best pleased with you doing that in the long term. The reason being that you are in effect accessing pre-tax profits, in that money that you're taking out, they would much rather you took it out as a salary or as a dividend, and therefore it can be taxed. If you're just taking it as a loan, the ATO sees that they'll be missing out on their share of tax on that, and therefore this Div 7A or director's loan section puts rules in place about what you can borrow and how much you have to repay and interest on those loans, which they'll force you to charge. And family trust, look, this 100A is for your accountant to worry about. For you guys, it's just worth knowing that whereas previously some gung-ho accountants would go out there and give $180,000 distributions to every man and their dog, every vague relative you could find, and perhaps the cash didn't actually track with that, the cash didn't follow the tax. The ATO has taken a dim view of that, and after 6 or 7 years has finally started to slap down on that. That does not mean family trusts are not beneficial, far from it. It just means that some of the cowboy operators are probably a bit more restrained on what they would do. We'll move ahead, and I've just seen a question pop up about New Zealand. We've got a company operating in Australia and UNZUD over the Dutch. You've had a strong year in New Zealand with big turnover, and Australia has been a loss. Recommended approaches for managing. This is fantastic. I dare say you need a little bit of transfer pricing assistance there. Please do feel free to reach out to us. Transfer pricing is if you've got a company in two countries or more, and they're related, so your ownership is the same, they should be dealing with each other on arm's length. I think what you might find here is that you've said that your New Zealand company has had a great year and Australia's had a loss. It may well be that you've got costs in your Australian company that should be reflected in New Zealand. Perhaps your management is in Australia and you're providing management services over to New Zealand. And that if you were to properly account for that on an arm's length basis, have said, well, I'm doing work for you for free, no, I should charge you for it, you might find that that levels off. Because you don't want to be in a situation where one country has profit and one has a loss. So that's a little bit of a taster. Please do feel free to reach out to us if you'd like some more assistance on that. Anne has said taxes in Australia are out of control. I'll probably take that as a comment. I think our tax system is reasonably straightforward. I don't think it's the best. It's not the worst. I think our tax rates aren't too bad. It's not so bad. I mean, I used to do a lot of international tax, as Connor said. There are plenty of countries out there that do it worse. What I just would say to that on taxes, are they out of control? Well, they're not if you have an accountant. The accountant knows what to do, and so I would also say that if you do set up a business overseas, but you live here, ultimately you will be taxed as an Australian anyway. Australian residents are taxed on their global income. So thank you for that question. All right, we're on to talking about our tax plans. Connor, did you want to step in, or did you want me to talk about that?
I've got a few future slides as well. Well, I talk about it again anyway. So
yeah, let's skip over it then.
yeah, and we've got obviously the BAS due dates everyone can see here. Although I don't know if you want to explain the difference there, Tim, between
Yeah,
the original due date and the extension there.
Just very quickly, if you're doing it alone, your BASs will typically be due 28 days after the end of the quarter, which is the end of March, end of June, end of September, end of December, with a little bit of an extension over the Christmas break. If you have a BAS agent or a tax agent, such as Lawpath Tax and Advisory, we get a further extension on that. So we get a bit of extra time. So if it is taking you a little bit longer to get your affairs in order, come over to a tax agent like us. We've got more time to get you lodged and compliant.
Yeah, absolutely. I mentioned at the start, for those of you who jumped in, we're already speaking to a lot of people who are behind on that. So if you are behind, definitely look at that tax plan to get that extension, and we can get that sorted for you ASAP. You would know a bit more about this, Tim, but this is what kind of the next stage of that. When you are on a tax plan, it's a conduct a general assessment. Obviously, we'll prepare you for the previous and upcoming lodgements, and then just take everything out of your hands from there. Most people I speak to, don't want to do their own taxes. We're happy to obviously, take this on for you with the documents, the lodging, crunching the numbers, all that good stuff. We've got some amazing accountants and lawyers to fill in the gaps, give you peace of mind that obviously your business is protected from certain liabilities, but also to improve the financial health of your business quarter on quarter or year on year. Which leads me.
I'm just very quickly, Connor, I'll just step in on that with a real world example from this week. I have a wonderful client who's gone it on their own in the first 9 months of running their business. They've done a great job of lodging their own BAS through Xero. But again, you don't know what you don't know. And where they let Xero lead them to create the BAS as it was, when they came on board with Lawpath, the very first thing we did a review of their files. We did a review of their lodgements. They were actually missing $6,000 worth of GST credits, which we very promptly claimed for them. So it's always nice to have someone else on your shoulder, maybe looking out for you and looking out for credits that you might have missed.
Absolutely. Yeah, which leads us into how Lawpath can help and how we can kind of consolidate all of that lovely information we've shared with you today. Here's a few additional things which we'd recommend you guys optimize. I'll be sharing the slides out later for those of you asking, so you'll be able to revisit these again. Obviously, this is why we do want to show this, the ATO small business inquiry findings, which you guys can find if you just do a quick Google search. There's a lot of info in it on some of the reporting mistakes and other issues of small businesses in there, but just the one I really wanted to quickly focus on is that, just as we say about taking a proactive approach, the ATO also recommend, speaking to your accountants on a regular basis. I remember actually a couple of months ago, Tim, we did a tax-related webinar, and a woman asked, should I be speaking to them more than just the year? I think it was a comment you said, and the answer is absolutely. As they state there, the accountant needs to have a bit more of a complete picture of your business circumstances. There's often a bit of an over-reliance if you're only checking them at that sort of once a year tax time. Having them, well-versed with your business and that kind of monthly or quarterly ongoings with your business just helps them make recommendations, helps them be more familiar with your BAS or your tax lodgements. And the same with your accounting softwares and tax obligations. Can assist you there, whether it's through MyOb or Xero, and provide you advice on your tax deductions and minimization throughout the year. It's not just a one-time thing. And here's our lovely team. I thought I'd quickly show their lovely faces. For those of you who actually did join later, missed my piece on introducing Tim. Tim, as you can see, is our head of tax and accounting. He's got some experience as a resident, running a tax division at director's level. He's worked within international tax. He has extensive experience in supporting entrepreneurial clients meet their tax obligations and advising them on making the tax system work in your best interest. And this is our Lawpath. We're kind of calling it off the cuff Lawpath Unlimited. It's our business success bundle. It includes everything from our legal, accounting, and tax advice. It is our best-selling bundle, primarily because there is a lot of crossover on the legal and accounting side. You can get unlimited consultations with both. Tim's mentioned a few things in today's webinar where it's optimal maybe to speak to a lawyer as well as an accountant, or at least have them both on hand And a few examples of that, as we discussed, is that business structure and setup, capital raising, your tax planning compliance, employment law and payroll, business contracts and your financial obligations around those, asset protection, your shareholder agreements and equity management, your trusts. The list goes on and on. There's a lot of crossover there where it would really be advantageous to your business to have both your lawyer and accountant in-house under one roof. I did see earlier as well, someone asked a question around the documents and the consultations. This is what it really looks like in action with the document builder. The contract builder is going to take you through step by step to each key provision and clause. The document is already 99% done. You just have to add in your relevant details, but there are additional tools there to assist you in helping you, with suggestions or things you may want to include, from drafting things from its input. And there are, as I mentioned at the start, there's their AI review as well. I saw someone as well comment about getting legal advice, or it'd be best to always get legal advice. Absolutely. At the end of the day, there's a very good reason why lawyers spend 6 years in like commercial law and learning about the law. We can't give anyone like a quick, fast track version of that. It really pays to, whenever you're doing contracts, to have those reviewed, whether it's getting, advice on certain clauses or provisions you're not sure of, but also getting advice around, what you should be tailoring, what you should be adding, the language of the language around what you're using, just making sure it's always fit to purpose for what you're doing. There's always things behind in the background of any particular contract. It pays to really speak to a lawyer to kind of understand those and get advice that will really give you that competitive advantage, and being really clever with your business. Oh, and look at this. Some of you may already have seen it on our website. We have all our discounts out there. We're super transparent with our costs, but we have a 40% off on our Black Friday offer. These are already actually applied. You don't even need the coupon code. It's already applied on our website at checkout. And that includes as well, in line with today's webinar, the 40% off on our annual tax plan. So this is the highest discount we've offered all year on that tax plan. As we discussed, it's the annual and quarterly BAS statements, your financial statements, and your annual business tax return. But you do get a very special initial tax consultation and an end of year consultation as well, which I believe, Tim, is more to kind of look at how the business performed overall, and kind of maybe project a rate going forward for the new financial year.
Yeah, that's right, Connor. It's there are steps that you can take, and this ties in nicely. Zach Lemon has asked some questions there. There are things that you can do closer to year end, and the reason why we have that consultation before 30th of June is we help you do them while you still can to reduce your taxes. Often, and in answer to your question, Zach, what are some things you can do to minimize your taxes? A lot of this isn't rocket science, but it's things like bringing forward your expenses. If you are planning on buying something in July or August, buy it in June. Why not? Get it a little bit earlier, get it tax deductible in that year. That's your first main lever. Your second main lever that a lot of small businesses ignore is perhaps pushing back your income into the next year. Perhaps you're the sort of business that has its degree of control as to when it invoices, when it performs its tasks. Maybe once your accountant is doing your year-end tax planning, they say, pump the brakes. You've made enough money this year, and this is your tax position, and perhaps you're better off putting some money into next year. There are steps you can take, Zach. It's again, there's no probably silver bullet out there that magically reduces your tax. We are taxed in Australia on your profits, which is your income less your expenses. So to the extent that we can justifiably change those two, income and expenses, that's going to be your key to really materially impacting your tax position. And that's why, as part of our tax plan, we offer that as an included service where we'll sit down with all of our businesses and see what we can do. Prepaying your superannuation is a fantastic one, particularly if you're closer to retirement anyway. Prepay some super, get some extra tax deductions for that.
Yeah, awesome. Good chance here, guys. If you do want to answer any questions, so we'll go to the Q&A. Just a quick piece here actually on our accelerator programs. We do have one on the legal side as well. Obviously, we have that accounting advice aspect where you have unlimited consultations with our team. So really, you could discuss any of these topics at any given time. But we really want to give you guys bang for your buck and maximize your usage of the platform, especially for those of you in your first 3 years of business, but even more so for those of you in your first year and just starting out. These accelerator programs are designed to try and get you as close as possible to understanding your business and running your business as if you were an accountant. And you'll see there's a few good examples there you can always pop in if you are kind of a loss to where to start. This would be a good position. That being said, if anyone does come onto our legal and accounting advice plans, or if you are on one but have not yet done it, would highly recommend booking in what we call a discovery call. Now, this is basically for us to understand your business in as much detail as possible, deal with any roadblocks you are currently aware of, but as Tim, he used my line, mentioned, you don't know what you don't know. So it's our accountant's job or our lawyer's job to kind of fill in those gaps, make you aware of things that could be an issue here and now, or could be an issue, in the future. And from there, we can recommend documents, recommend, next steps, and obviously lay out a bit of a roadmap for this side of the calendar year and financial year.